Crypto markets grind higher as the ETH merge gets closer to reality. Bitcoin struggles to break resistance, lagging stocks as ETH steals the limelight. Vol is starting to look cheap in Bitcoin, inducing buyers of Vega and options, but ETH looks rich ahead of the event, with vol spreads at extremes. All this and more in this week's Crypto Insight. Okay, crypto this week. Bitcoin remains pretty capped. So I had said that if the S&P broke 4,200, as it did on the lower CPI last week, that was the chance for Bitcoin to break 25 and we could test 27, 28 basically. And Bitcoin has basically done that. It got to 25 and then got rejected almost straight away. So pretty pathetic performance from Bitcoin, if you ask me. The trend is still mildly positive, but with no clear catalyst and the relative short flows that I think are coming from Ethereum long positioning, it's much safer to buy Ethereum if you're selling Bitcoin against it than just buying it by itself, right? So I think there's been a lot of selling on Bitcoin from people who are buying Ethereum. Along with that, you've got the Mt Gox selling pressure. There's probably been offloading more coins onto the market. It's hard to really see what's going to drive this rally further. Okay, if it couldn't rally on that risk on that we got last week, I'm really not sure what's going to make it rally. Okay, I do continue to favor the medium term downside. We do need to break out of this ascending channel. So kind of 21K seems to be the support zone that needs to break now to really start to go lower. But I'm starting to slowly add back some hedges in October. So between October and December, I think is the sweet spot for like macro hedges now that you want to be looking at. And right now, put spreads are quite an easy one to put on in October on Bitcoin. And then, at some point, when you think the Ethereum driven sort of move up is done, then selling calls on Bitcoin as well to help fund some of those put spreads is a bit of a no-brainer against any Bitcoin long holdings you might have, right? So put spread collars look quite good. Vol's come down a lot in Bitcoin, but it's still, we'll talk a bit about vol later, but it's still at 60 plus, right? So there's still some juice to be had in like put spread collar type hedges. And then the Ethereum kind of, if you look at that, really the best chart to bring up is the relative spread. And I've had this blue sky target up 0.089. We got within sort of 10% away from it. We've pulled back a little bit, back down to this kind of average. But to be honest, it looks intact, right? So this ratio broke above this resistance here on the back of that successful testnet merge that happened last week. They brought forward the actual mainnet merge date to the 15th from the 19th of September. Okay. Now that might still get pushed back as we get closer to it. It's a function of the hash rate. So if the hash rate goes up, then it will happen sooner. If the hash rate goes down, it will happen slower. It's the actual block number that they decide. And then the date just kind of happens when it happens. But basically, for now, there's no reason to kind of, I've shaved off a little bit of my bullish risk reversal position that I had in September. So, because the move, it's done a lot of the work now, right? It's hard to really know how much. It could still have a massive blow off move on the event. Who the hell knows? But for me, the easy money's kind of almost been made. So I was happy to take off. I did a zero cost risk reversal, 2,400 calls versus 1,000 puts in September against Bitcoin short futures. And I've taken half of that risk reversal position off. Okay. So I've still got some on. And obviously you guys also know that I've got my call ratio position in August on as well, which has been ticking away nicely. This thing is up nearly 15x again, right? So those call ratios have just been the best way to play Ethereum upside that you can imagine. And then the last sort of thing, we mentioned last week on Ethereum, this kind of proof of work potential for a hard fork. And that the idea that in the proof of work version of ETH that lives on, there's going to be an airdrop of a new token. And the market was pricing in the value of that token in the futures basis. By going long spot and selling futures, you get access to that airdrop basically, right? Now, as it turns out, there's actually a market price for that, which I didn't realize until today, right? So you can see here on my slide that we've got this chart here, it tells you that the market price of this Ethereum proof of work IOU is about $64 right now. Okay, so if it ends up being the actual value of that token, that's an airdrop of approximately $8 billion, right? That's going to happen, right? So I don't know, like how, I have no idea how they come up with pricing that $64, but that is apparently what it's worth right now. And then if you look at the kind of basis in September futures, in terms of, if you look at the deribit basis in September futures, which is kind of like the future that encapsulates that merge date, then they are trading at around $20 underneath the spot price, versus a proof of work value potential of $64 right now. So make from that what you will, but it's just, I think it's an interesting thing to keep an eye on for sure. What it tells us about what the price of ETH is going to do, I have no idea, right? But you know, there's all sorts of potential volatility that can occur as we go through that merge date. And so I'm not going to be looking to be overly exposed on that merge date. What I'll probably end up doing is taking a lot of my delta down, and maybe just kind of having some cheeky little bets on for like out of the money call spreads or something like that, to maybe be exposed to that as we get closer to that date, right? But for now, shaved a bit of the September risky off. Happy to carry the August call ratio, because I think that's going to just grind higher and might actually get very close to maxing out. Not that I think I'll run it until expiry, but if that thing gets above $200, I paid $10 for it. If it gets above $200, I'll probably take it off again, right? So that's the kind of target that I'm looking at right now. Okay, on that note, I'm going to hand over to Aaron for some on-chain action.
Week for on-chain, we're once again looking at Glassnode's Bitcoin on-chain analysis, and the general theme for this week was Glassnode was looking at the distribution of supply and wealth between young and old coins as a way to better understand Bitcoin's current ownership structure and what that means moving forward. So starting out here at the top left, we're looking at the total supply held by long-term holders denominated in Bitcoin. As a quick reminder, the long-term holder threshold is 155 days. So that would be anybody who obtained their coin roughly March of this year. And so basically this long-term holder supply chart here is a way to assess the behavior of holders that are statistically less likely to sell because they have a higher conviction. And then as that long-term holder, people who've had their coins for over 155 days. And so the two main takeaways from this chart here in the top left is that you can see since the November high, we've been pretty range bound in the long-term holder supply, this orange line, which is just works its way up and down, you know, oscillating between 300,000 coins up to 13.56 million down to 13.27. And then the other takeaway being that since that Luna sell-off, which is denominated here, it started in this red area, you see we've been just slowly grinding our way down with lower highs and lower lows. This decline has been roughly 150,000 coins that have gone out from long-term holders. But it's worth noting here that Glassnode points out that there isn't much of a steep capitulation, drastic move needed in long-term holders for it to be a capitulation event. This slow grind down is pretty much all you can expect, as these are usually the stronger hands. So as weaker hands get flushed out, these long-term holder supply does tend to work its way down a little bit, but then it usually kind of stops where it's at, accumulates, and then slowly works its way back up. And so with the kind of definition of these coins being sold, they become short-term holder coins, and it just takes a little bit of time for those coins to mature and become long-term holder coins. And you can kind of see that here in the top right. So with this chart, we're looking at the short-term holder 30-day position change. And so with that 150,000 coins that got drained from long-term holders combined with coins that went out via exchanges, you saw a big spike in the short-term holder supply, marked by this green spike right here, of roughly 330,000 coins. And so it's worth noting that these spikes in short-term holder supply, these green spikes here, usually come in bull market tops, where you see speculation getting out of hand, short-term holders pile in, and then things get overheated. But what you'll see is these green spikes denoted by the red circles are the few outliers where you saw big spikes in short-term holder supply coins actually happening in bear markets. And so what you're basically you can see is that these inflow events were a response to extreme drawdowns in price, and it signifies a transfer of coins going from new buyers that initially get classified as short-term holders, but since they have that lower cost basis, it's easier for them to hodl from there, and they slowly become long-term holders, potentially marking a bear market floor of buyers. And you can see that reiterated here in the bottom left by the Bitcoin hodl waves, but only showing young coins, which young coins is coins that are only been held for 3 months or less. And so once again, you can see these spikes here denoted by these blue arrows and these blue sections, which is a spike in young coin supply. And what's worth noting is you can see that these spikes in young coin supply looks to come distinctly after capitulation events. So deep drawdown, spike, deep drawdown, spike, deep drawdown, spike, and the pattern continues, basically kind of signaling that when you get this spike of young coin supply in bear markets, it seems to signal a flush out of sellers, followed by months of gradual accumulation, and then eventually maturing of coins into long-term holders. And then if we move over here to the bottom right, looking at the realized cap hodl waves, it's just a way to look at the same sort of thing, but instead of looking at Bitcoin denominated like we are over here, we're now looking at USD value. And so what you're not seeing in the realized cap hodl waves is you're not seeing that big spike in denominated value that you're seeing over here. And that's because while the young coin cohort has been accumulating roughly 300,000 Bitcoins in recent months, the value of that coin has just been steadily declining, as we all know, from up around 50, 60,000 down to 20,000. And so we've now fallen down to historical macro lows. You could see here below this dotted line for that USD wealth for young coins. And so it's basically saying that we may have already seen the meaningful capitulation event for this bear market, but it will fall on these new short-term holders, these people that accumulate these coins in the flush out from the long-term holders. It's going to fall on them to stay strong and keep holding when we face potentially even further downward price pressure. You know, I think most people in this call tend to be in the camp of the macro headwinds still coming. So what we're going to need to see is these new short-term holders to stay strong, even if we do plunge below 20K, in order for this to really be a bear market bottom. If you do see some more selling, if those people do turn out to be more speculative than long-term holders, then you will potentially see some more distribution and selling of coins in the market. Moving on from there, this week we're doing things slightly differently. Instead of 2 pages of on-chain, we have that first page of on-chain, and now we're going to look at crypto exposed equities, something that we're going to feature more in our analysis, and basically just to give you a broader view for people maybe who can't trade directly on Bitcoin, Ethereum, etc. You can potentially use these equities as proxies. We're using Blockware for this analysis. That's the same company that Will Clement works for, that we featured his on-chain. And this week, the crypto exposed equities we are looking at are Coinbase, Marathon Digital, and CleanSpark. Coinbase and Marathon Digital both recently had Q2 earnings reports. So diving into those, starting with Coinbase, we can see the Q2 net revenues was roughly 803 million, which was a 31% drawdown quarter over quarter. 65 million of that came from transaction revenue. 147 million was from subscription and services revenue. And then additionally, Coinbase did unfortunately see 200,000 users withdraw from the platform, which came along with $160 billion decrease in total assets on the platform, 76 billion being removed from retail, 85 billion being removed from institutional assets. The other thing to keep in mind, though, is that this drawdown in value was pretty in line with the general drawdown in market capitalization from the price decreases in things like Bitcoin and Ethereum, and that in the face of that, you still had 2 billion worth of Bitcoin added to the platform. That's a 5% increase quarter over quarter. That's while the asset itself, Bitcoin, was at a 56% drawdown from its all-time high, and non-Bitcoin crypto on the Coinbase's platform has decreased by 23%, perhaps suggesting that this blow up of cryptocurrencies and hedge funds and these different things that we've seen this year perhaps is kind of repositioning, reiterating Bitcoin's value prop as the only truly decentralized asset for more serious investors. And then moving on to the right, looking at Marathon Digital's Q2 report, again, we see a decline in revenues, not particularly surprising as it is linked to the drawdown in the asset prices themselves. reporting a 24.9 million revenues for the quarter. That's a 52% decrease quarter over quarter. Marathon did attempt to offset this by selling some of their equipment. If you recall our previous talks of on-chain where we spoke about miners and miner capitulation, this is pretty on point, where you have the weaker miners having to pull some of their Bitcoin, the ASIC miners offline in order to kind of navigate their margins getting squeezed. Additionally, Marathon had announced that they had to kind of repurpose and restructure their financing with Silvergate, ticker SI. So they had to refinance their revolving credit, but additionally they had to add 100 million in credit that they had to collateralize with Bitcoin and matures in 2024, just to kind of keep the business afloat. And really just these two earning reports really illustrate how these crypto businesses are affected in bear markets, kind of regardless of the industry, right? Marathon's a miner, Coinbase is an exchange, but no matter what your kind of business model is, if you're in these crypto related companies, squeezes on margins from the lower asset prices is pretty much universal and unavoidable. And lastly, before we sign off here, we have CleanSpark, CLSK. Blockwork highlighted them just as we've kind of had some interesting price action on their chart. You saw a big 28% pop last week here on Wednesday. That was on 271% greater than its 50-day moving average for volume on the back of two pretty well-received announcements. First, CleanSpark acquired a Bitcoin miner for 16.2 million in Georgia. This is significant when you compare it to something like Marathon Digital, where many miners are taking equipment offline. CleanSpark is adding. And then additionally, CleanSpark will be announced they'll be pivoting away from their other business model of providing consumer-facing energy products to focus solely on Bitcoin mining. Again, these two things really well received. You saw a big jump on Wednesday and then a 12% gap up on Thursday. But you could see it did kind of pull back a little bit, but it has been constructive since then. Friday and then yesterday, slowly staircasing its way up. So potentially kind of forming a rounding bottom here and ready to battle these moving averages and start moving its way up to better price action. And that is this week's on-chain and crypto exposed equities.
Okay, so on the vol side of things, so as expected, short-term vols got hit post CPI last week. Didn't have to be a genius to figure that one out. Realize has bounced off the lows, so you can see Bitcoin Realize hit around 40, it's kind of trickled back up towards just above 50, and the implied carry that was as high as 30 vol points has come down to about 15, and that's for both Bitcoin and Ethereum. And that's currently sits in the 70th percentile. So a reasonable amount of carry still, if we compare the average between 1 week and 1 month at the money implied compared to 10-day realized, which is how I calculate the carry. Okay. And you can see that these red bars coming down, there's that carry kind of reducing and the implied realized kind of converging basically. Okay. FOMC minutes might provide some macro volatility this week, but I kind of suspect that this lower realized regime stays into the end of the month, and until Bitcoin breaks the range that is established for the month, around that 25k sort of range, then there's not really going to be a rush to buy volatility basically. Then if we move on to kind of term structures, just put here the two term structures, how they've changed, and then the spread term structure, which I think is definitely worth paying attention to now between now and the merge date, because there's potentially a trade here and a lot of action going to go on here, right? So term structure shifting lower, and even the back end vol under pressure. So you can see here that Bitcoin back end was down quite a bit, front end was down more, and then the Ethereum was almost a parallel shift there, basically, right, in the curve. So people may be thinking, you can sell that Vega without taking on too much short gamma exposure for the merge. It's going to come down eventually, so you don't mind selling some here while it's expensive. Okay, that's probably what some people are doing. Obviously, no clear event risk for Bitcoin relative to Ethereum, so that's why the curve's gone into like a steep contango, whereas the Ethereum curve has got that hump in the 30 to 60 day bucket around the merge timeline. Yeah, and then you also look at if you look at the spread. So this is a term structure of the vol differential between Bitcoin and Ethereum. You've got this hump in that bucket as well, right? So the only part of the curve really above 30 vols is that bucket that contains the merge. And then both the longer dated and the shorter dated are both now coming down towards where they ultimately want to go. So now they're around 25, but a month ago, the whole curve was at 20. And the truth is, it kind of lives at about 15 or 10, basically, right? I suspect that's where it's going to end up going, right? So after the event's out the way, and right now, the realized vols are kind of, you see here the 1 week realized and the 30-day realized differentials are at 30, 35. So they're justifying the spread for now. But the chances are, once the merge is done and we've had our gap and it's all out the way, this will probably move to something a bit more in line with history, and the spread will go back closer to 10, 10, 15. And then the realized will probably be somewhere in line with that as well. Okay. So I think that's where we're heading, but we're just not going there next week, right? We're probably going to hold this premium until the event's out the way and the market kind of digests what it needs to digest out of all the flows that come out of it. And then we'll see where the dust settles, basically. Okay. Then if we move on to skew, you basically got 1 month and 3 month skew here. I've got both Bitcoin, Ethereum, and I've got the spread. So last week I'd mentioned a surprising observation to me was that Ethereum skew for puts was trading above that of Bitcoin. And given that Ethereum was the one that had the upside catalyst, that didn't make a ton of sense to me. Okay. That has flipped back the other way round now, very slightly. Okay. Not massively, but Ethereum puts now do trade slightly under. Okay. And we did see that pop above 2000 over the weekend that maybe got people a bit excited. Okay. But I think that the message I would take is that it's clear that many of those who have levered up on the merge long ETH play have probably bought puts to protect themselves because they're worried about this sell the fact move that happens either on the merge or just before the merge or just after the merge, and that they don't want to get carried out on that, basically, right? So they're probably buying delta and buying downside against it, and that's kind of creating this bid for put skew that otherwise kind of wouldn't be there. And also another way of thinking about it as well is that, say the merge is a big re-rating event that sends ETH up to 2,500 or whatever the hell it is. Once that's done, the vol's going to get annihilated. So if you go and buy a load of upside calls and then you rally into them and then the vol on them gets destroyed, that might not be amazing, right? You might give a lot of your gains back via the vol resetting down. So a better way of positioning might be to be long a shitload of ETH, but own downside. And then when we rally, your downside evaporates to puts that are worth nothing. You don't have any Vega exposure and you don't really care, basically, right? So that might be why people are structuring it that way. And we know that people are structuring it using call flies and stuff, which are a vol neutral type structure. People don't necessarily want to pile into the upside because they're worried that when we get there, vol's going to get annihilated on those calls. So that's something to kind of be aware of. And it's something you have to think about as an options trader when you're trying to play direction through options. Vol's super expensive in ETH. There's no way it doesn't come down. It's just a question of how much it comes down, right? Okay, that's my thoughts there around why skew's doing what it's doing. But in general, I just think we're going to see some pretty damn choppy price action around the 15th of September and into that day. So, I wouldn't want to be caught too short gamma or anything like that on Ethereum, right? I think that's pretty dangerous. Okay. Now, if we look at the open interest lining up for sort of end of August, so it's not this Friday, but the one after. You look on Bitcoin, reasonably big expiry for Bitcoin. You can see here, the peak in the open interest is around 25, 26K. So quite a significant peak in open interest, and it's all calls basically, right? Now, normally I would have expected that to be street long calls, dealers long, clients short, like overwriting. But as it turns out, the directional model that Genesis Volatility have to try and keep track of the net gamma of the street is actually suggesting the street short those options. Okay. And then if we go back to the implied realized spread, well, if the street was long a shitload of gamma that was realizing 40, 50, well, then would the implied vols be at 60? Probably not. Right. So the fact that there's an implied realized gap with implieds trading over actually does kind of confirm the idea that actually in this zone where there's a reasonable amount of gamma on these 25, 26 calls in Bitcoin, street probably is short them. Yeah, that wouldn't surprise me. Now, it's not leading to a lot of realized because Bitcoin's got no bloody catalyst, but I thought that was quite an interesting thing that they've got on their GEX model, right? And their GEX model, I think, is probably better than any other GEX models out there in terms of crypto, because they're really tracking the direction of all the flows that happen, and that's what's feeding into that model basically. So something to be aware of. But anyway, like Brent of Spot Gamma says, doesn't really matter if the street's long or short. A lot of the time, if there's a lot of open interest there, the thing sticks to there anyway, basically, right? So we may well end up dying in that zone in Bitcoin into next Friday, basically. Just something to kind of be aware of. Now, if we look at the same thing on ETH, it's a much smaller expiry on ETH relative to where the open interest lies on ETH. No one really gives a shit about August for obvious reasons. The big open interest is DEC 22, March 23. That's where all those call flies and call spreads have been going up. September is obviously a decent one as well, because that's the actual date. But if you look at the August open interest profile, you can see it's much more uniform across all of those strikes from 1,200 all the way up to 2,200, right? So no reason to really know or think anything's going to be particularly stickier in Ethereum. It could kind of go anywhere. Whereas there's a much bigger peak in the open interest on Bitcoin, which may likely have more impact, I would say. Yeah. Okay. And then the last slide, as always, is our crypto flows. What are the main flows we saw? Still massively dominated by calls over the last week. Bitcoin seeing buying of volatility in general. March 23 calls in the 34K, 36K area being bought with Delta Hedge. So people buying Vega there, locking in kind of some mid-60s type levels in longer dated Vega, which doesn't sound like a bad idea. You also had October 2030 strangle buyer here. And then you had some on-screen put selling in the strike sort of below 20K. Okay, but I've put in the gravity charts, I've just kind of circled these big blobs because this gravity chart shows net weighted Vega. So you can see in terms of net weighted Vega, the biggest blobs were those big March calls that went up in that 35K region, and then that big October strangle that went up, basically. That's where the big lumps of Vega kind of traded in terms of block trades last week. If you then look at Ethereum, more mixed flows in Ethereum, buying and selling going on all over the shop. We are still seeing ongoing call spread buying in the post-merge maturities. So, you see this circle here, October, December, March 23, people buying call spreads, whether it's a 25-30 call spread, whether it's the 35-40 call spread and DEC, those are the type of things that are going up. So less call fly action, but more just call spread buying. Maybe that's a sign of some bullish conviction increasing now that the testnet went successfully. You did also see some speculative short-term buyers of call spreads as well in August. So there's a 1750, 2100 call spread buying going on there. And then you also saw at the end of the week, you see this vol selling that I've circled here. There was some March 23, 2300 straddles that were sold. So some Vegas selling there as well in the back end of the week after we got that shift higher in spot. People thinking, okay, we're getting close to that sell the fact type moment. So I want to start selling some long end Vega, basically, right? So those are the crypto flows that we are seeing. And that's kind of it from me on crypto this week. Thanks for watching, guys. If you like this content, please subscribe to our channel, give the video a thumbs up, and hit the notification bell so you don't miss out on future videos. To watch the entire macro call, which includes the live Q&A and a walkthrough of all my top trades, you can sign up for a free trial to Macro Insight. If you join our exclusive trading community, you'll get access to our Telegram group, and you'll also get weekly market reports summarizing the macro call. The link is in the description to the video. And for more information, you can connect with us on socials, or you can visit our website, options-insight.com. Thanks a lot.